Investors were never excited about the mining stocks because they never believed the rally in gold and silver. And I think what's really caused this sentiment to get negative, not just the new idea that we have a hawkish Fed that's going to, come out swinging with these rate hikes, but the fact that gold went down during the war is leading a lot of people to question whether or not gold is even a safe haven anymore. Like, hey, why did it go down? Why didn't it go up? And they overlooked the fact that it went up so much before the war. It already priced the war in before the war happened. And by the time the war happened, it was to buy the rumor, sell the fact. Plus, gold was so overbought going into the war. I believe had we started the war and gold was still around 3,000 and silver was still around 30, both would have gone way up during the war. The only reason they didn't, the only reason they came down was because they went up so much right before the war started. But that's created a lot of false negative sentiment on the metals that, hey, they don't work anymore.
Gold's pullback during the war should not be mistaken for a failure of safe haven demand. The move looked more like a market that had already rushed ahead before the headlines arrived. This distinction matters because panic trades often reverse before the larger investment case has changed in any serious way. Peter Schiff, a well-known economist and market commentator recognized for his long-standing focus on sound money, argues that the recent weakness in gold and silver should be attributed to timing, positioning, and investor sentiment rather than to a broken long-term story. The sharper takeaway is that the metals had already priced in fear before the conflict began, leaving them vulnerable to a buy the rumor, sell the fact reversal. That does not erase the case for gold. It only shows how volatile short-term trades can be. Mining stocks remain underappreciated because many investors still doubt the metal's rally itself. If sentiment resets, the same skepticism could become fuel for the next move, especially if silver and gold regain momentum while broader markets struggle with rate pressure, inflation anxiety, and fading faith in paper assets. Now, we present the clips from Peter Schiff's interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
Investors were never excited about the mining stocks because they never believed the rally in gold and silver. And I think what's really caused this sentiment to get negative, not just the new idea that we have a hawkish Fed that's going to, come out swinging with these rate hikes, but the fact that gold went down during the war is leading a lot of people to question whether or not gold is even a safe haven anymore. Like, hey, why did it go down? Why didn't it go up? And they overlooked the fact that it went up so much before the war. It already priced the war in before the war happened. And by the time the war happened, it was to buy the rumor, sell the fact. Plus, gold was so overbought going into the war. I believe had we started the war and gold was still around 3,000 and silver was still around 30, both would have gone way up during the war. The only reason they didn't, the only reason they came down was because they went up so much right before the war started. But that's created a lot of false negative sentiment on the metals that, hey, they don't work anymore. And a lot of the gold enthusiasm over the past decade was stolen by crypto and Bitcoin. And that's where all the action was. That's where all the hype was, all the Wall Street money, all the political clout was being concentrated on Bitcoin, and that stole a lot of gold's thunder. But I think as the air really comes out of this Bitcoin bubble, and it's coming out, it's just going to come out faster, and more people are going to recognize it. Right now, your typical Bitcoin guy is like a deer in a headlight. He doesn't even realize what's coming. He's just frozen. But they're all going to get hit by a Mack truck, and that's going to take the spotlight off of Bitcoin and put it right back on gold where it belongs. And I think to the extent that crypto is going to be a part of it, it's going to be about tokenized gold. Gold is the future of blockchain, not Bitcoin. Instead of making gold obsolete, blockchain makes gold better. It makes it more fungible, more divisible, more portable. It makes gold better money. Bitcoin was never money. Even though it was on a blockchain, it wasn't money. Gold's been money. But now when you tokenize it, it becomes even better money. It does everything that Bitcoin promises to do, but can't. I'm more of a value investor. I'm not buying into hype, and I'm trying to, win it, like the tortoise, not the hare, right? I want to win and cross the finish line. I don't want to, run out of breath and drop dead, having to lead, most of the way, and then I don't make it. So I'm still buying what I've been buying, which is precious metals, mining stocks, commodity stocks in general, energy, agriculture, emerging markets, value, dividend-paying companies, foreign stocks. And, I had a great year last year. Best year I've had in, I don't know, maybe my career on the long side.
Yeah, for
And
sure.
I think that was a breakout year. And, a bit of a pullback. Still, I think we're still beating the U.S. market year to date with international stocks. Gold stocks, though, are now negative, but not much. But I think they're going to end up beating the S&P on the year. I think they'll end up beating the NASDAQ on the year, too. So we'll see how the rest of the year plays out. But it's not quite half over yet. The government is running deficits now of like 3 to 4 trillion a year. If you look at what we're spending versus what we're collecting. Where's the government going to get that money? The only source would be the Fed. The Fed is going to have to buy a lot more government debt. And it's going to create money out of thin air. It's going to create inflation in order to do it. Otherwise, long-term interest rates are going to soar. Because if we have to find private buyers, because who's going to buy? Remember, who are the big buyers of treasuries? It was foreign central banks. They're not big buyers. It was U.S. government trust funds, Social Security Trust Fund. Man, they're sellers now. The Social Security Trust Fund sells U.S. treasuries every year. It's not a buyer. It's a seller. So foreign central banks aren't buying. Government trust funds are selling. Who's going to buy? Is the public a big buyer? No, the public's not buying treasuries in a big way. They don't have any money anyway. The average American is broke. Doesn't have any money for treasuries. But when the average American decides to invest, he doesn't want to invest for 4% yield. They're buying SpaceX. They want to go to the moon, right? They don't want to clip a 4%, 5% coupon, even if treasuries were 6 or 7%. They don't want that.
Yeah.
So there's just no demand there. The Fed is going to supply it. Now, it shouldn't. The Fed should allow the collapse. The Fed should force the government to cut spending. I think we lost the war for the same reasons that I said we would lose it the day that we declared it. We didn't achieve our objectives. We did not change the Iranian regime. They're still in power. Yes, we killed some of them, but the people that replaced them are the same, cut from the same cloth. They may even be more radical and more extreme. Who knows? But we didn't really, denuclearize Iran. We're basically acknowledging that they're going to continue to enrich uranium and have nuclear so long as they don't use it for weapons. But that was exactly the position that we were in before the war. The Iranians never said that their goal is to have a nuclear bomb. They just said they needed a nuclear to have power. And we just didn't take their word for it. And now all of a sudden we trust them. So we haven't really achieved anything. We wasted a lot of money. We blew up a lot of our missiles and bombs that now I guess we have to replace. But in order to get this deal, we had to make a lot of concessions to Iran. We had to agree now that we'd waive the sanctions and they could sell their oil. We have to agree to return to them, even as part of the MOU, billions of assets that we had frozen. And we're working to arrange, assuming that we get a final deal, a $300 billion investment fund to invest in Iran. And ultimately, Iran is going to be able to decide what kind of fees it wants to charge ships that end up passing through the Strait of Hormuz, where before the war, it was getting nothing. So I think Iran wins simply because it survived. We threatened to get rid of the regime, and the regime is still standing. And they signed a deal that economically empowers them, that enriches them. Yes, we did diminish their military capabilities as far as conventional weapons are concerned. But that military was never a threat to America. Their ships, their planes, their missiles, they were never going to target the U.S. mainland. So to the extent that maybe he's less of a menace in the Middle East, that may be a benefit to some Middle Eastern countries, but I don't see the direct benefit to the United States. But meanwhile, Iran is going to have a lot of money now from investment capital, from oil sales, from fees on the Strait to rebuild whatever it wants of its military. We have no restrictions on what they can spend their money on. They can do whatever they want with it. And we don't have, now they're talking about maybe having some inspections But they haven't even agreed to that yet. So far, it's just we have to just trust the Iranians, which is the exact position that we were in before. So I think Trump made a mistake in declaring the war. And then once he realized that he couldn't win, he tried to figure out how to get out of it, how to surrender and pretend to win, which is really, what Trump does anyway. Everything is pretend. Everything is make believe. We have a lousy economy. Just claim we have the greatest economy in the history of the world. Right? Mm-hmm. Just pretend everything you do is the best and the greatest, no matter what the reality happens to be. And, that's part of, we talk about why the dollar is going up, because you have Kevin Warsh, pretending that he's going to fight inflation, that he's determined to restore price stability, that he's, going to succeed where his predecessors failed. And that's all a bunch of talk. He admitted that inflation is a choice. And it is. We choose inflation. Powell chose inflation. Yellen chose inflation. Bernanke, Alan Greenspan, who just died, he wrote the playbook, choosing inflation. And Warsh is going to make the same choice for the same reasons. Because if you choose not to have inflation, then you choose a massive recession, a huge drop in stocks, in real estate, in bonds. Maybe you choose a financial crisis. You choose to force fiscal responsibility on the government. But he's not going to choose that for the same reason nobody has chosen that. The government is about 50% bigger now than it was before COVID. It's spending 50% more money. We're spending like $7.5 trillion a year, but we're barely collecting $5 trillion a year in taxes. Where's that extra money coming from? It's debt, and it's being monetized. And if the Fed doesn't create that debt, that there's no way that the government can service it. So we're going to have inflation because that's how we pay for government. And the Fed is going to enable it under Walsh.
Bitcoin's appeal was not only technological, it was also emotional and political, and was heavily promoted by Wall Street. For years, that attention drained energy from gold, making gold feel old while speculative crypto looked like the future. But the stronger argument is that hype can fade quickly when price weakness exposes the lack of real monetary substance beneath. If the Bitcoin bubble keeps losing air, capital and attention could rotate back toward assets with deeper history and clearer utility. The more practical version of crypto may not be Bitcoin at all, but tokenized gold, because blockchain can make a real monetary asset easier to divide, transfer, and use. That prediction is worth taking seriously. Technology does not have to replace gold. It may make gold more useful. The real shift could be from digital scarcity stories to digitally improved hard money. Now, let's get back to the interview.
Well, first of all, Japan is sitting on over $1 trillion of treasuries.
That's right.
And if they're in a financial, position, a difficulty where they need to pay down debt and raise cash, an obvious source is the U.S. Treasury market. They have this big pile of U.S. Treasuries that they can liquidate. So that immediately impacts us. But also, as the yen that puts upward pressure on interest rates in Japan. I mean, year over year, import prices in Japan are already up 25%. And, that's a big deal. And now it's going to go up even more. As the yen weakens, by definition, everything costs them more. And so as the yen weakens and inflation accelerates, that puts more pressure on yields in Japan, which now, if you look at the 30-year yield, it's almost 4%, like 3.8. A couple of years ago, it was less than 1. And the 10-year bond, which is yielding, what is it, like 2.6, 2.7? That was 10 basis points a couple of years ago. And it was 10 basis points, I think, from like 2017 to 2022. I mean, almost zero. The Japanese government was borrowing at close to zero on 10-year paper. But now, with 2.7%. But as that yield rises, it becomes a competition for treasury yields. And, not just, all these sovereigns compete. The Japanese government's borrowing, European governments are borrowing. The U.S. government is borrowing, right? So all this competes. So as yields go up there, it's going to put upward pressure on our yields. And Japan is running debt to GDP right now. They're running a deficit of about 4.5% of their GDP. That's a lot of debt. especially when they're already at 250% debt to GDP. And they're adding debt as interest rates are soaring. So Japan could find itself in a sovereign debt crisis even sooner than we find ourselves in one. But obviously, if Japan gets into a crisis, that is a problem for us too. Well, first of all, I don't think everything is fine in Japan. I think there's going to be a big problem.
Okay.
But just because Japan could get to 250% doesn't mean that we can, because there are some other key differences. Japan is still a creditor nation. That means that the Japanese own more foreign assets and foreign debt than foreigners own in Japan. You know, almost all the Japanese government debt is held by the Japanese. They don't owe it to the Europeans. They don't owe it to us. Whereas in America, we're the world's largest debtor nation. We owe more money than all the other debtor nations combined. So we have an external drain. So when we pay interest, we don't pay it to ourselves. We pay some of it to ourselves, but a lot of it we pay abroad. Japan pays almost everything to itself. Japan also has balanced trade. They have a surplus some year deficit. We have over $1 trillion a year trade deficit. So we don't just have to finance budget deficits. We have to finance trade deficits. And our GDP is much more heavily concentrated in the service sector. The biggest employers in Japan are still manufacturers. The biggest employers in America are FedEx, UPS, Amazon, and Walmart. They don't produce anything. All they do is sell shit and transport it around. But the stuff they're selling and transporting were made in foreign countries. So our GDP is a lot of fluff. So I don't think we have anywhere near the run room that Japan had. I think they had a lot more rope to hang themselves with than we do. But they're still going to end up dangling on that rope. We're going to dangle on a shorter rope because we can't get to 250%. There's just no way that it's going to get that big here. But the other thing that we have that they don't, we have the reserve currency. So that's bought us some time. That's the only reason I think it's gone on as long as it has.
But at what point would Japan be forced to sell U.S. treasuries?
I don't know. I mean, I guess they're never forced to. They can keep printing money and destroy the yen. But to me, they need to sell their U.S. treasuries and pay down debt. But even if they sold all of their foreign exchange reserves, they can only pay down about 15% of their debt. So they'd still have a big problem. But at least they can make a dent in it. You know, it makes no sense to just hold on to that and keep selling, you know, printing more yen and issuing more Japanese government bonds when you have this pile of treasuries you can get rid of.
So bring it back to home, the Fed has to raise interest rates to combat inflation, but they can't raise it too much, whereas the bond market's going to break and the economy is going to crack. So well,
it's not just raise interest rates.
Yeah.
They got to keep. If they don't keep printing money, the balance sheet is still expanding. Look at what's going on. They have to keep buying bonds. They have to keep doing quantitative easing. Because if they don't buy these bonds, who will?
The debt problem is the core pressure point. Washington is spending far more than it collects, and the missing money cannot be made up by ordinary taxpayers forever. Foreign central banks are no longer reliable treasury buyers, government trust funds are selling, and households are stretched. That leaves the Federal Reserve as the buyer of last resort, which means more money creation, more inflation, and more damage to purchasing power. The uncomfortable logic is that inflation becomes the political escape route. Refusing to monetize debt would force spending cuts, weaker stock prices, lower real estate prices, and possibly a financial crisis. So policymakers are likely to choose the easier path, even while promising discipline. Rising global yields make the setup worse. Japan's debt load, weakening yen, and need for cash could push it to sell treasuries, adding pressure to American rates. The United States still benefits from the reserve currency privilege, but that advantage only delays the reckoning. A realistic forecast is that bonds, currencies, and inflated asset prices become more fragile together. In that environment, precious metals, commodity producers, dividend-paying value stocks, and foreign markets may attract investors seeking protection outside the usual U.S. growth trade as financial conditions continue to tighten. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.